Welcome back to the Deep Dive. Today, we're strapping in for a really thorough look, ground up at a world that just dominates trading talk online.
Oh, yeah, absolutely.
We're talking about proprietary trading firms or prop firms. They promise this, like immediate access to massive financial power.
Huge amounts of capital, seemingly.
Right, but they operate under, well, arguably some of the strictest rules you'll find anywhere in finance.
It's a really fascinating ecosystem,
Mhm.
especially for anyone out there who's maybe skilled at trading but doesn't have a lot of capital, maybe just a few $100 to risk.
Yeah.
These firms, they offer what seems like this unmissable chance. We're talking potentially accessing $50,000, $100,000, even $200,000 in trading capital.
Wow.
And the hook is, without ever having to risk your own personal savings beyond that initial fee.
That promise, that huge leverage for, like you said, a minimal upfront fee, that's the real draw, isn't it?
Sure.
But the debate around them, it's just constant. Are they, truly a meritocratic path to becoming a pro trader? Or are they more like a cleverly designed funnel?
A trap, almost.
Yeah, a sophisticated trap built to basically harvest fees from hopeful traders who, ultimately don't make it.
And look, our mission today in this deep dive is to try and answer that with, hard data and just mechanical clarity. We need to define the two very different kinds of prop firm out there.
Okay.
Then we got to dissect the mechanics of their challenges, clarify what their business model really is,
Yeah.
and the risks involved, obviously.
Crucially.
And yeah, crucially, ground the whole discussion in the actual success rates.
Yeah.
So you, listening, can really understand the odds before you even think about jumping into this high leverage field.
Okay, let's nail down that definition right away because, like you said, if you say prop firm to two different people, they might be thinking of completely different things.
That's a critical distinction. So first up, we've got type 1, the traditional or institutional firm. These are the big names, the Jane Street, Jump Trading,
Yeah.
maybe Citadel Securities. They operate like, institutional investors.
Okay.
They recruit talent straight out of top schools, or they hire experienced traders. They pay a proper base salary, offer loads of mentorship.
Like a real job.
Exactly. And the traders, they're executing complex strategies, market making, stat arb, that kind of thing, using the firm's own private capital, their own money.
So type 1 is basically a salaried career path. It's exclusive, high barrier to entry. You're an employee of a proper financial institution.
Precisely. Their goal is long-term employment because they're genuinely investing in developing that trader to execute the firm's bigger strategy. If the trader wins, the firm wins directly. It's, the classic model of high finance.
Gotcha. But the type of firm that's really captured everyone's imagination online, the retail market, and the one we're really focusing on today, that's type 2, the retailer-funded trading shop.
Right. And these operate under a completely different model.
How so?
These modern type 2 firms, people often call them evaluation service providers. They're basically offering an audition, like a tryout.
Yeah.
They give individual traders a way to prove they can be consistent, but under incredibly strict risk rules. If they pass this audition,
Then they get funded.
yeah, funded, usually with simulated capital, we need to stress that, and they get a majority cut of the profits they make, often like 80 or even 90%.
Okay, simulated capital is a key point we'll come back to. Now, some of our sources, maybe less kindly, call these places trading arcades or even bucket shops.
Yeah, you hear that. Because of the sheer volume of people trying and, the business model often relying on people failing the challenges. But that appeal, it's still massive.
Well, why?
What's the core appeal then?
It's just the unmatchable value proposition, really. You could be looking at getting access to, say, a $150,000 futures trading account
Which is huge.
for a tiny fee. Maybe a one-time fee, maybe monthly. Sometimes as low as like $149. That's powerful for two main reasons.
Okay, what are they? First, scale. Access to scale. Lots of retail traders are stuck with small accounts, maybe $5,000. It takes ages, years sometimes, of compounding to get anywhere meaningful. Prop terms let them trade bigger, immediately.
Right, bypasses years of saving.
Exactly. And second, maybe even more important, risk management. A prop firm challenge forces you to be disciplined, but it protects your personal savings.
How does it protect them?
Well, if you mess up, if you break the rules and blow the account, the only money you lose is that small evaluation fee you paid up front.
Ah, okay.
You get to feel the pressure of trading bigger size, learn how the market feels without risking your, life savings.
So it's kind of a stepping stone between just practicing on a demo account and actually trading live with your own cash. It forces you to develop discipline for managing six figures, but it only costs you, what, maybe a few lattes if you fail.
That's a pretty accurate way to put it, yeah. It's the ultimate high-leverage, low personal risk deal for a skilled trader who just lacks capital. The big question, though, is whether the rules are actually fair enough to let skill win out.
Which leads us perfectly into the next part, the gauntlet, navigating that whole evaluation process. Okay, let's get into mechanics. You pay the fee. You're now the challenger. What does this evaluation actually look like? Is it just one big test?
No, it's usually a multi-phase audition, generally 2 steps. It's designed to measure consistency and how well you stick to the risk rules, not just, if you got lucky on one big trade.
Okay, 2 steps.
Yeah, you pay that upfront base fee, sometimes it's monthly, and that gets you into their simulated trading environment.
Walk us through those phases. What's typically involved?
The structure is pretty standard across most firms, though the exact numbers might vary a bit. Phase 1 is usually about proving you can actually make profit.
Right.
So it might require you to hit, say, a 10% profit target on the account size. Once you manage that, without breaking any rules,
You move on?
you move to phase 2. And that often has a lower target, maybe 5% profit. Phase 2 is more about checking if phase 1 was just a fluke, and if you can hold on to discipline while managing the gains you just made.
Okay, that makes sense. And the incentive. You mentioned the fee.
Right, the carrot. If you pass both phases and get to your first successful payout as a funded trader, they usually refund that initial challenge fee.
So it's less of an expense and more like a deposit if you succeed.
Exactly, assuming you pass. But the real walls of this gauntlet, the things that make it tough, are the restrictive rules. Our sources agree they're there to test discipline, but critics argue they're also subtly designed to make people fail.
And generate reset fees.
Precisely. You fail, you often have the option to pay a reset fee and try that phase again. It's a revenue stream.
Okay, let's dive into those rules then. There are 2 big ones we hear about, the daily loss limit, DLL, and the maximum drawdown, MDD.
Yeah, the daily loss limit, or DLO, that's the most immediate danger day to day. It's a hard stop loss amount, usually set around 5% of the starting account value.
So for a $50,000 account,
There'd be a hard stop at $2,500 loss for the day. If your account equity dips to that level at any point during the trading day, boom, account terminated instantly. Doesn't matter if you were profitable before.
wow, okay, so that completely stops any kind of emotional revenge trading after a bad loss, forces you to just walk away for the day.
Absolutely. The DLL basically dictates your maximum usable risk capital in any single 24-hour period. If you can't stick to that, you just won't make it.
Okay. And the maximum drawdown, the MDD?
That's the overall loss limit for the account, often set at 10% of the initial balance. This is the total amount the account can draw down from its starting point, or sometimes its peak, before it's terminated permanently. It's the bigger picture limit.
Gotcha. Now, we get to the really tricky one, the most crucial and controversial rule, especially in futures trading, the trailing drawdown. You said we need to take this one slow.
Yeah, this is absolutely critical to understand. It's why sometimes making a profitable trade can, counterintuitively, feel like it puts you in more danger.
How does that work?
So the trailing drawdown means your maximum allowable loss level, the floor below which your account gets terminated, actually follows your profits upward. It trails your account high watermark.
Okay.
It's designed, from the firm's perspective, to ensure they only ever risk that initial maximum loss amount they set out. Let's use our $50,000 account example again, with a maximum drawdown allowed of $2,500.
Okay, $50K account, $2,500 max loss. Step 1, the start.
Right at the start, accounts at $50K. Your trailing drawdown floor, the point you can't drop below, is $50,000 minus $2,500. So $47,500, you have $2,500 of breathing room, your usable risk capital.
Makes sense. Step 2, I make a good trade. I bank the profit immediately. Let's say I make $1,000. My account balance is now $51,000. Where does my floor move?
Okay, in this simple case, because you realize the profit, your floor moves up by that $1,000 as well. It stays $2,500 below your new account balance high. So the floor moves to $48,500. You told $2,500 of room. $51,000 minus $48,500. That feels okay.
Right, that seems logical. But the trap, you're saying, is when it tracks the unrealized peak, the highest point the account reached, even if I didn't close the trade there.
Precisely. That's where it gets dangerous. Let's restart that step 2 scenario. You enter a trade. The market moves your way fast. Your account value momentarily surges up to, say, $52,000. That's an unrealized gain of $2,000.
Okay, I'm up $2 on paper.
But before you can click close, the price snaps back. You end up closing the trade with only $1,000 in actual realized profit. Your account balance settles at $51,000.
So I still made money, a $1,000 profit. But my highest point, even just for a second, was $52,000.
Correct. And the trailing drawdown often locks onto that $52,000 peak. Therefore, your new liquidation floor becomes $52,000 minus the $2,500 drawdown limit, which puts your floor at $49,500.
Whoa, hang on. That changes everything. I made a $1,000 realized profit. My balance is $51K. But my floor jumped up $2,000 from $49,500 originally straight to $49,500. I started with $2,500 of room, but now I only have $1,500 of room, $51,000 minus $49,500 before I blow the account.
That is the insidious nature of the trailing drawdown, as many traders experience it. It heavily rewards very quick, small, profit-taking scalping, basically.
Right.
And it actively punishes strategies that involve more volatility or wider stop losses. Because a big unrealized gain, even if it reverses quickly, can dramatically shrink your actual usable buffer, sometimes even leading to failing the account while you're technically net profitable on the day.
Wow.
As one source put it, you can feel like you're doing well, making money, but that money doesn't actually buy you more safety or room to maneuver. In fact, it can reduce it relative to your current balance.
That totally explains why firms like, say, Atex Trader Funding, which historically used this trailing model quite aggressively, were super popular with scalpers, but could be really frustrating for traders trying to catch bigger moves, like swing or position traders.
Absolutely. It shapes the kind of trading that can succeed under those specific rules. Now, the alternative, and what many traders prefer, is called a static drawdown, or maybe an end-of-day EOD drawdown.
Okay, how's that different?
It's much simpler and, frankly, more intuitive. Your maximum loss level is fixed based on your starting balance, or it only adjusts based on your account balance at the end of the trading day, not intraday peaks.
Ah, so profitable trades actually do increase your buffer?
Yes. It makes profitable trades feel like actual rewards that give you more breathing room. Firms like FTMO and Take Profit Trader are often cited as using these static or EOD models, which feel fairer to many.
Good to know. Okay, beyond the drawdown rules, are there other limits, like how or when you can trade?
Oh, yeah. They definitely enforce other boundaries on trading style. The main one is usually time constraints. Most evaluations and even funded accounts require you to be a day trader.
Meaning?
Meaning you generally cannot hold positions overnight or over the weekend. You have to close everything before the market session ends.
Why is that?
It's about risk for the firm. There's increased risk of big price gaps when markets reopen after being closed, so they limit that exposure. Although it's worth noting, some firms are now starting to allow overnight holds, probably because so many traders want it.
Okay, and what about once you pass? You get funded. Can you just withdraw profits right away?
Not always. Many firms have what's called a cushion rule.
A cushion?
Yeah. You might need to build up a certain amount of profit above your starting funded balance, say $2,000 on a $100K account before you're allowed to make your first withdrawal.
Okay.
And if you do withdraw money, you might have to build that cushion back up again before your next withdrawal. It basically acts as a buffer for the firm, using your initial profits to cover potential small losses before their own capital is at risk.
That makes sense from their perspective. They want to see a bit of a safety margin built up by the trader before they start paying out cash, protecting their own bottom line.
Exactly. It ensures the trader has some skin in the game via their initial profits.
Right. Let's pivot now to the business model itself, because this is where I think a lot of the skepticism comes in and where traders really need clarity. The biggest misconception seems to be that once you pass phase 2, you're suddenly trading real live money.
Yes. This is the simulation secret. And it's maybe the single most important thing for people to understand. The vast, vast majority of the time, that funded account you're trading, even after passing the challenge, is still a simulated account.
A demo.
Pretty much. Insiders sometimes call it demo shit, to be blunt. It feels live because the data feed is real time, the rules are real, the loss limits are binding, and they will pay you based on its performance. But the trades themselves aren't necessarily hitting the real market with real capital initially. The profits are just numbers on their server until they approve a payout.
Okay, so if I'm in my funded SIM account and I make, say, $5,000 profit, where does the firm actually get the $4,000, assuming an 80% split that they pay me?
This gets to the absolute core of the Type 2 prop firm business model. And it's why that comparison to a Ponzi scheme sometimes comes up, even though that's a loaded term. Payouts to the small percentage of winning traders are largely funded by the fees collected from the overwhelming majority of traders who fail. They fail the evaluation, or they get funded and then blow the account later.
So the huge number of people who pay the challenge fee or pay for resets, they're essentially funding the payouts for the tiny fraction who actually succeed and withdraw money.
That's the primary engine, yes. The statistics bear that out. We'll get to the exact numbers later, but the failure rate is incredibly high. That creates a massive incentive for firms to keep the rules strict and the challenges difficult.
It certainly does. So is that their only revenue stream, just fees from failures?
No, and this is important for legitimacy. The primary stream is challenge fees and reset fees. But they usually have a second, potentially more sustainable source of revenue, which also shows they're interested in actual trading success.
Okay, what's the secondary stream?
Data and reputation. The firm analyzes the trading data from their successful, consistent traders. They're looking for profitable patterns, profitable strategies, what the industry calls alpha. They figure out what works from their best traders, the entry points, exit points, timing, and then they use their own large pool of capital to replicate those exact successful trades on the real live market. Sometimes this is called A/B booking or trade replication.
Ah, okay.
Yeah.
So the profitable trader in their simulated account is almost like an unwitting algorithm designer for the firm.
In a way, yes.
When that trader makes, say, $1,000 profit in their sim account, the firm might be placing the same trade, but maybe with 100 times the size, using their real money in the actual market and making a much larger real profit from it.
That's the idea.
And the 80% cut the trader gets from their sim profit is then effectively like a commission or performance bonus for providing that winning signal or strategy.
That's the mechanism, exactly. The profit split 80% to the trader, 20% to the firm, or whatever it is, becomes legitimate trading profit for the firm derived from the trader's success. This is also why some firms do eventually offer a path to a genuine live account.
Right.
If a trader proves they are consistently profitable over a long period, the firm might eventually trust them enough to allocate real capital directly to them because they've validated that trader's risk model and strategy. Firms like TopStep or Apex have been known to do this for their top performers.
Okay, that distinction between sim and potential live trading is crucial. Now, this leads us straight into the fraud discussion, the transparency, or maybe the lack of it. Let's talk red flags. If the business relies so heavily on high failure rates, where does the line get crossed between just being a tough but fair evaluation and being an outright scam?
Yeah. The biggest red flag usually revolves around denying payouts, even after a trader has seemingly met all the profit targets and followed the main rules.
How can they do that?
Sometimes they invoke vague consistency rules. They might say your profits were too explosive or not earned consistently enough over a certain number of days, or maybe your strategy was deemed too risky or not replicable, even if you never hit the daily loss or drawdown limits.
So basically, if you win too much, or in a way they don't like or can't easily copy.
It can happen, especially if a trader finds some kind of edge or uses a strategy that's maybe so profitable, it actually threatens the firm's ability to manage its own risk or replicate the trades effectively. In those cases, they might just terminate the account, keep the simulated profit, essentially saying your style doesn't fit our model. That's a major point of contention.
Definitely a huge red flag. What else?
Another big one is the market the firm focuses on. Firms dealing primarily in contracts for difference, CFDs, or Forex, are often seen as, let's say, sketchier. They tend to attract more regulatory scrutiny.
Why CFDs and Forex specifically?
Well, CFDs and retail Forex are often less regulated or operate in regulatory gray areas compared to, say, exchange-traded futures. Futures data comes directly from a centralized, regulated exchange like the CME, Chicago Mercantile Exchange.
More transparency there.
Generally, yes. The whole controversy around my Forex funds, MFF is a good example. They were a huge CFD-focused prop firm that faced serious allegations and regulatory action from bodies like the CFTC in the U.S. Futures firms, just by nature of dealing with exchange products, tend to have a higher barrier to entry and operate within a more established regulatory framework.
Okay, so a potential rule for listeners. Maybe lean towards firms with a longer track record, better reputation, and perhaps those focused on regulated markets like futures.
That's generally good advice. Longevity and reputation are really key. Look for firms that have been operating for several years and have a demonstrable history of actually paying traders out consistently. Names like FTMO, the Fivers, TopStep often come up as more established players.
Why do they survive?
Presumably because they've successfully figured out that secondary revenue stream, how to reliably identify and replicate the profitable strategies from their winning traders. Also, look for clear, transparent payout terms. Are the withdrawal windows and processes straightforward? If a firm is constantly changing its rules, especially the payout rules, or if they seem to rely only on super aggressive, deep discount marketing all the time, that could be a sign to be cautious.
That makes the distinction pretty clear. The legitimate firms want consistent, replicable profit generation from their traders to fuel their own trading. The sketchy ones might rely almost entirely on churning through fees from failures.
That's a good way to summarize the spectrum, yeah.
Okay, let's get down to the absolute bottom line. Can you actually make money doing this?
Yeah.
Given the tough rules, the business model, we need to look at the real numbers, the source statistics. This is where the reality check really hits, right?
It really does. And the numbers are, frankly, pretty brutal. They absolutely have to ground any decision about whether to try this. Based on data from large surveys tracking hundreds of thousands of challenge attempts across various firms, the average pass rate for just phase 1 of a typical challenge is only about 10%.
Wow, only 10%. So 9 out of 10 people who pay the fee don't even clear that first hurdle.
Exactly. They hit the daily loss limit, they fall into the trailing drawdown trap, they run out of time. Whatever it is, 90% fail phase 1. Now, for the 10% who do make it to phase 2,
How do they fare?
the average pass rate for phase 2 drops again. It's often only about 50% of that remaining group who succeed.
Okay, so 50% of the initial 10% carry the 1. That means only about 5% of all starters actually pass both phases and reach funded status. Oh wait, my math. 10% pass K1, then 50% of those pass P2. That's 0.10, 0.50, 0.05. No, wait.
Let's recheck. If 10% pass phase 1, and then roughly half of those pass phase 2, maybe the source meant 5% of the original group pass phase 2. Let me reread that. Okay, the source says average phase 2 pass rate, 5%. That could mean 5% of the original pool pass phase 2. Or maybe 5% of those who start phase 2 pass it. Let's look at the next number. Make it to a funded account. You're 3%. Okay, that clarifies it.
Right, so roughly 3% of everyone who buys a challenge actually manages to pass both phases and get the funded account.
Yes, around 3%. That's already a very small, very dedicated subset of traders.
3% make it. Now the really crucial question. How many of those funded traders, that elite 3%, actually manage to keep trading successfully, navigate the rules like the cushion and drawdown, and actually receive a payout, withdraw real money?
This is the most sobering statistic. Of those who get funded, only about 10% to 15% typically manage to sustain profitability long enough to make a successful withdrawal.
Okay, so 10 to 15% of the 3% who got funded.
Right. If you trace that all the way back to the initial pool of people who bought a challenge in the first place, it means only somewhere between 0.3% and 0.45% of all starters ever successfully receive a payout.
Less than half of 1%.
Less than half of 1%. It is an incredibly elite club.
Wow.
That is the cold, hard, mathematical reality of this business model. It confirms that to succeed and get paid, you literally need to be in the top, like half of 1% of everyone who attempts this.
The psychological weight of that is huge. You have to accept that the system is largely funded by the failures of almost everyone else trying alongside you.
Absolutely. And it also helps clarify what success even looks like financially for those who do make it. Are they becoming millionaires overnight?
Yeah, what kind of money are those few winners actually seeing?
Well, not usually millions, especially not initially. The average first payout for those rare traders who reach it tends to be relatively small, often around 4% of the nominal account size.
Okay.
Successful, consistent prop firm traders aren't aiming to double their account every month. That's usually a recipe for blowing up. They're aiming for steady, repeatable gains, achieving a consistent 5% monthly return on a large funded account. That's considered fantastic. That's top-tier performance in this space.
Let's put that 5% monthly into perspective. Say a trader is on a $100,000 funded account. A 5% return is $5,000 profit for the month.
Right.
If they have an 80% profit split, they receive $4,000 into their bank account.
Correct. And remember, they likely achieved access to that $100K account for an initial challenge fee that might have been, say, $500 or maybe even less depending on promotions.
So the return on investment for the trader's actual capital risked the fee is potentially enormous.
It's untouchable, really, if you have the skill but lack the starting capital.
Yeah.
You're risking a very small amount, maybe $50 to $500, to get access to capital that could generate thousands per month in income.
Yeah.
And once you secure that first payout and your initial challenge fee is often refunded, the trader is then leveraging potentially hundreds of thousands of dollars with essentially zero personal capital risk remaining.
That's the core attraction, isn't it? You get to play in the big leagues, financially speaking, without needing a big league bankroll yourself.
Exactly. If that same skilled trader tried to grow their own small personal account, say $5,000, they'd have to take enormous risks percentage-wise to try and generate $4,000 a month. Their risk of ruin would be incredibly high.
The prop firm provides the leverage buffer.
It provides the leverage that lets them scale their edge safely, turning relatively small percentage gains into meaningful income, assuming they can navigate the rules.
Okay, so given those incredibly stark statistics where only that tiny fraction succeeds, the main quality these firms are really testing isn't just trading knowledge, is it? It's discipline, extreme discipline.
100%. The core reason most people fail isn't lack of a potentially winning strategy. It's almost always behavioral.
Like what?
Lack of discipline, terrible risk management, letting emotions like greed or fear, what traders call going on tilt, take over after a win or a loss. A huge number of people treat the evaluation like a lottery ticket. They try to pass it in one single day.
The home run attempt.
Yeah, the home run,
Right.
which almost guarantees they'll slam into the daily loss limit or the trailing drawdown and fail immediately.
So how do people adopt the mindset of that winning 0.45%? What are the practical techniques they use?
Okay, first and foremost, they adopt the grinder mentality. They trade small.
Yeah.
They focus on consistent base hits, not home runs. They might trade only one or two contracts or lots all day long, just taking small, consistent profits repeatedly.
Like scalping or very short-term day trading.
Often, yes. This approach directly counters the danger of the trailing drawdown we talked about. By banking small, realized profits frequently, and not letting their account equity spike wildly on big unrealized gains, they keep their drawdown floor much more stable and protected.
So consistency beats aggression in this game.
Absolutely. And this is backed up by incredibly rigid risk caps. Successful prop traders live and die by their personal risk limits, which are often tighter than the firm's limits.
For example,
Maybe risking no more than 0.5% of their account capital on any single trade, and aiming to stop trading for the day if they hit a 3% total loss.
even though the firm's rule might be 5%.
Exactly. If you can mentally and actually cap your own daily loss at 3%, you create a buffer. You ensure you never even get close to hitting the firm's 5% DLL that terminates the account. It preserves your mental capital and keeps you in the game longer. You really can't succeed here if you can't religiously respect a daily loss limit.
Makes sense. And what about preparation? What happens outside of the actual trading hours?
Journaling and backtesting. These are non-negotiable for the pros. They use data. They track every trade. They analyze why they won or lost. They understand their edge. What time of day does their strategy work best? What market conditions? They review entries, exits, stop placements. It helps them avoid impulsive trades and overtrading.
And using that data.
They develop rule-based entries. Many successful traders literally write down their precise entry and exit criteria before the market even opens. They might have a checklist. And the rule is absolute. Unless this exact setup appears, the one I wrote down on my sheet this morning, I will not take the trade. No exceptions, no gut feelings.
That level of mental fortitude, it's like removing the emotional human element entirely. Just executing a predefined plan.
It's the ultimate mental shift required. The focus has to change from how much can I win to how do I absolutely not lose. If you can manage your losses effectively, protect the account from the drawdown rules above all else, the profits tend to take care of themselves over time if your strategy has an edge.
Okay, so you managed to become part of that tiny percentage. You're funded, you're getting payouts. Is that the end goal? Just stay funded with the prop firm forever?
For almost every successful trader interviewed or discussed in our sources, absolutely not.
No.
No. The prop firm is seen as the best possible stepping stone. It's the ideal way to gain access to significant capital and really refine your strategy under real pressure if you start out undercapitalized. But the ultimate goal for nearly everyone is to transition away from the prop firm and use those payouts to fund your own personal live trading account.
Okay. And why make that transition? What are the benefits of trading your own account if the prop firm gives you leverage?
Two main reasons: freedom and taxes.
Explain freedom first.
Once you're trading your own capital in your own brokerage account, all those external prop firm rules disappear. No more Trailing drawdown traps breathing down your neck. No more daily loss limits imposed by someone else. No cushion rules. No risk of having a payout denied because of a consistency rule.
Yeah.
You are 100% in control of your strategy, your risk, your timing. You can hold trades overnight, over weekends, trade news events, whatever fits your strategy, not the firm's.
Total autonomy. Makes sense. And the tax implications you mentioned, that sounds important.
Yeah, this is a really crucial point, especially for traders in the U.S. Payouts from most prop firms are typically treated as ordinary income. You get paid as an independent contractor, usually receiving a 1099 NEC form at tax time, meaning that income is taxed at your regular income tax rates, which can be quite high. However, if you transition to funding and trading your own futures account,
Yes.
your trading gains and losses often fall under a much more favorable tax rule in the U.S. tax code, specifically Section 1256.
And what does that do?
Section 1256 contracts, which include regulated futures, get special tax treatment. Generally, 60% of your net gains are treated as long-term capital gains, which have lower tax rates, and only 40% are treated as short-term capital gains, taxed as ordinary income. This blended rate usually results in significant overall tax savings compared to being taxed fully at ordinary income rates via a 1099 NEC.
Wow. Okay. That's a potentially huge difference to your bottom line over time.
It really is. So the roadmap for a dedicated, aspiring trader becomes pretty clear.
Lay it out for us.
Stage 1. Master a trading system with an edge. Prove it works consistently in simulation first. Stage 2. Use a prop firm challenge, navigate the rules, get funded, and start generating capital via payouts even though it's tax disadvantaged initially. Stage 3. Systematically take those prop firm payouts and funnel them into building up your own personal live trading account.
Until that personal account is large enough to trade your strategy effectively without the prop firm's leverage.
Exactly. Then you make the switch, gain full freedom, and benefit from the better tax treatment, especially if trading futures. You basically leverage the firm's capital until your own capital base is sufficient.
That's a very clear pathway. This has been an incredibly detailed deep dive, really breaking down what's often a very complex and, aggressively marketed industry. Prop firms, these type 2 evaluation firms, they absolutely offer genuine opportunities for massive leverage that most people could never access otherwise. But wow, the mathematical realities, the psychological hurdles, they are incredibly high.
They really are. The entire system is designed fundamentally to find and reward only that elite, almost machine-like level of consistency and discipline.
So if you listening are considering this path,
you absolutely must prioritize doing deep research first. Understand the exact drawdown mechanism of any firm you consider. Is it static? Is it trailing? How is it calculated? Practice your strategy religiously on a demo or paper trading account until you can pass the challenge parameters multiple times consecutively without failing. Treat that challenge fee not as a gamble, but as like tuition for a very, very difficult, very exclusive university course.
where the main subject is discipline itself.
Precisely. The discipline is the product you're developing.
Okay, so we'll leave you with this final, maybe provocative thought to chew on. We've seen the stats. If only around 0.45% less than 1 in 200 of everyone who buys a challenge ever actually gets a payout, what specific, measurable, and highly disciplined steps must you commit to, starting today, to have any realistic chance of not being part of the 99.5% whose fees ultimately fund the system?
Something to really think about.
Indeed. Until next time on The Deep Dive.